You know what nobody tells you about getting old? It's not the aching joints or the early bedtimes. It's watching the same movie play over and over again. Except each time, different people are the actors. And somehow, they all think it's a brand new script. I've lived through 14 recessions now. 14. And here's what's wild about that number. When I was young in my 20s, I thought each one was unique. Special. This time it's different, we'd say. This time the rules have changed. But you live long enough, you start to see the pattern. It's like watching the tide. You stand on the beach, and the water comes in, and it goes out, and it comes in again, and people act shocked every single time. Where did all this water come from? Where did it go? Well, it went where it always goes. It's doing what it's always done. I'll probably see another 1 or 2 recessions before I'm done. That's just reality. That's just the way the economic machine works. Up and down, boom and bust, expansion and contraction. It's baked into the system. It's not a flaw. It's a feature. And here's the thing that most people never grasp. You can't stop it. You can't change it. Politicians will tell you they can. Economists will build fancy models. The Federal Reserve will adjust interest rates. And sure, they can influence the timing a little bit, maybe make things slightly better or slightly worse, but they can't stop the cycle. Nobody can. But here's what you can do. You can prepare for it. You can position yourself. You can learn to see these cycles not as disasters, but as the single greatest wealth-building opportunities you'll ever encounter in your lifetime. And that's what I want to talk to you about today. Not just surviving the next recession. Anyone can survive. I want to show you how to thrive. How to come out the other side wealthier, more secure, more confident than you went in. See, most people have this completely backwards. They think recessions are times to hide under the bed, times to pull back, sell everything, stuff cash in the mattress, and pray it all blows over. And I get that instinct. I really do. When you turn on the television and every channel is showing red numbers. When your neighbor loses his job. When your retirement account drops 30% in 3 months. When your brother-in-law is talking about moving back in with his parents. The natural human instinct is to panic, to run, to protect what you have left. But here's what I've learned over 75 years of doing this. That instinct, that very natural, very human instinct is exactly wrong. Recessions aren't when fortunes are lost. They're when fortunes are made. Made. Let me say that again because I need you to really hear it. The biggest wealth transfers in human history don't happen during boom times. They happen during busts. They happen when everyone else is running for the exits and a small group of people, people who prepared, people who understood what was really happening, they walk calmly in the other direction and pick up incredible assets for pennies on the dollar. Let me take you back to 2008. The financial crisis. You remember it, I'm sure. If you were old enough to be paying attention, you remember where you were when Lehman Brothers collapsed. It was a Monday morning, September 15th. I was eating breakfast, reading the paper, and there it was. One of the biggest investment banks in the world, 158 years old, gone. Just gone. And that was just the beginning. I remember sitting in my office in Omaha, watching the news coverage. Every channel, every single channel, doom and gloom. Banks, failing left and right. Bear Stearns, gone. Washington Mutual, gone. Wachovia, on life support. Companies that had been around for 100 years, vanishing in weeks. AIG, the insurance giant, getting bailed out by the government. General Motors, Ford, Chrysler, all lining up for government money just to keep the lights on. People losing their homes, foreclosure signs on every street. Unemployment climbing toward 10%. The stock market falling 50%, cutting retirement accounts in half. And it wasn't just the numbers on a screen. It was real people suffering. I'd get letters, emails, phone calls. Warren, I'm 62 years old. I was supposed to retire next year, and now half my savings are gone. What do I do? Warren, I lost my job. My house is underwater. I have 2 kids in college. I'm scared. And that fear, that genuine terror, it was everywhere. You could feel it. You could taste it in the air. Smart people, experienced investors, people who'd been in the market for decades, They were all running for the exits. Everyone wanted out. Sell everything, get to cash, hide, wait for it to be over. I had friends, sophisticated investors, calling me up. Warren, what are you doing? Are you selling? Should I sell? This could get worse. This could be another Great Depression. And you know what? They weren't wrong to be scared. It could have been that bad. For a moment there, the entire global financial system was teetering on the edge of complete collapse. But I saw something different. I looked at that fear, that massive, overwhelming panic, and I saw opportunity. I saw sale prices. And I remembered something I'd been saying for years, something I learned from bitter experience in earlier cycles. Be fearful when others are greedy, and be greedy when others are fearful. So right in the middle of the crisis, October 2008, when things were at their absolute worst, when it felt like the world was ending, I did something that made people think I'd lost my mind. I wrote an op-ed for the New York Times. The title was, "Buy American I Am." And I laid it out. I said, look, the financial world is a mess. The economy is going to get worse before it gets better. But America's best days are ahead. And I'm putting my money where my mouth is, and I did. I bought Goldman Sachs, $5 billion investment. I bought General Electric, $3 billion. I bought Dow Chemical, Swiss Re, Bank of America, Harley Davidson. Billions of dollars going into the market while everyone else was pulling billions out. People thought I was insane. My phone was ringing off the hook. Warren, what are you doing? You're going to lose everything. This is crazy. But I wasn't crazy. I was calm. Because I understood something fundamental that most people miss about recessions. They're sales. They're clearance events for good businesses. Think about it this way. And I want you to really think about this because it's the key to everything. Imagine you love shopping at a particular store. Let's say it's a store that sells high-quality furniture. Beautiful stuff. Solid wood, expert craftsmanship, built to last a lifetime. Normally, a dining room table in this store costs $5,000. A couch costs $3,000. And you've always wanted to furnish your home with their stuff, but it's expensive, so you wait. Then one day you drive by and there's a huge banner out front. Everything must go. 70% off. The store isn't going out of business. The furniture is the same quality. Nothing changed about the product. They just need to move inventory. What do? You load up, right? You buy that dining room table for $1,500 instead of $5,000. You get the couch for $900 instead of $3,000. You're thrilled. You tell all your friends. You can't believe your luck. But here's the weird thing. With stocks, when the exact same thing happens, when everything goes on sale during a recession, most people do the exact opposite. They sell, they panic, they see prices falling and they think, oh no, something must be wrong, I better get out before it goes to zero. But nothing's wrong with the underlying business. General Electric was still making jet engines. Coca-Cola was still selling 1 billion drinks a day. Johnson & Johnson was still making Band-Aids and baby powder. The businesses didn't change. Just the prices changed. And that's the opportunity. Those investments I made in 2008, they did extraordinarily well. Made Berkshire tens of billions of dollars. Not because I'm smarter than everyone else. I'm really not. I make mistakes all the time. But because I understood that simple principle. Good businesses at cheap prices. That's it. That's the whole game. Now let me be very clear about something before we go any further. I'm not sitting here telling you that recessions are fun. They're not. They're painful. They hurt real people. If you're not prepared, if you don't have savings, if you're leveraged up with debt, a recession can destroy your life. I've seen it happen. I've watched people lose everything. Their homes, their savings, their marriages, their health. It's devastating. So I'm not making light of any of that. What I'm saying is that if you prepare, if you position yourself correctly, if you follow a disciplined strategy, then recessions transform from existential threats into opportunities. And that preparation, that strategy, that's what I want to walk you through now. Step by step. The same approach I've used for decades. The same approach that's worked through every recession, every crisis, every market crash I've ever seen. Part 1. Build your war chest. First thing, and this is the foundation everything else is built on, You need cash. Cash is king going into a recession. I know what you're thinking. Warren, you spent half your career telling us that cash is trash, that inflation eats away at cash, that we should be invested, not sitting in cash. And that's all true. Under normal circumstances, cash loses value over time. If you keep $100,000 in cash for 10 years and inflation averages 3%, you've lost purchasing power. That money buys less than it did when you started. But here's the thing. There's a time for every strategy. There's a season for planting and a season for harvesting. And going into a recession, you need cash, you need dry powder, you need ammunition. Because when that recession hits, when asset prices fall, you want to be able to buy. But if all your money is already invested, if you're 100% in stocks, then you can't take advantage. You're just sitting there watching your portfolio shrink, watching opportunities go by, unable to act. I call it dry powder, and it's a military term. Back in the old days, soldiers carried gunpowder, and if your powder got wet, your gun didn't work. So you protected your powder, you kept it dry, you saved it for when you really needed it. That's what cash is. It's your dry powder. It's what lets you act when others can't. Now, how much cash should you keep? That's going to depend on your personal situation, your age, your income, your job security, your risk tolerance, your obligations. But here's my general framework, and you can adjust it based on your circumstances. At a minimum, you need 6 months of living expenses in cash, not invested, not in stocks or bonds or crypto or gold. In cash, in a bank account, available immediately. This is your emergency fund. This is what protects you. If you lose your job, if you have a medical emergency, if your car dies, if your roof starts leaking, this money is not for investing. This is for life's emergencies. And if you don't have this, stop everything else and build this first. Because without this foundation, you're vulnerable. One bad month, and you're in crisis mode. If you're older, say over 50, I'd increase that to 9 months or even a year of expenses. Because if you lose your job at 55, it's harder to find a new one than at 30. The job market isn't kind to older workers, and that's just reality. So you need more cushion. If your job is less secure, if you work in a volatile industry, same thing, more cash. If you're a tech worker and your company is burning through venture capital, keep more cash. If you're in retail or hospitality, industries that get hit hard in recessions, keep more cash. But that's just the defensive cash. That's the money that keeps you alive. For investing purposes, you want another reserve. A separate pool of money that you don't need, that you won't need for at least 5 years. Ideally longer. Money that, if you lost 50% of it tomorrow, your life wouldn't change. That's your investment reserve. That's the money you deploy when stocks are cheap. How much? As much as you can save. If you can save 20% of your income, great. If you can save 40%, even better. The more you save, the more ammunition you have when the sale comes. I've always kept large cash balances at Berkshire for exactly this reason. We've held $20 billion, $50 billion, $100 billion, sometimes more. And people criticize us constantly. Analysts write reports. Investors complain. Warren, you're sitting on all this cash. It's earning nothing. It's wasteful. Put it to work. Buy something. Do something. But I know what I'm doing. I'm waiting. Waiting for the right pitch, as I like to say. I'm a baseball player standing at the plate, and pitches are coming, but they're not in my sweet spot, so I wait. I don't have to swing. I can wait for the perfect pitch. And when 2008 came, when 2020 came, when opportunities presented themselves, I was ready. I had the cash. I could write checks while everyone else was scrambling. That's the first part of the strategy. Build your cash reserves. Be patient. Wait for your pitch. Part 2. Make your shopping list. Now, second thing, and this is absolutely crucial. You need to know what you're going to buy before the recession hits. This is where most people fail. They have the cash, they have the intention, but when the recession actually arrives, they freeze. They can't pull the trigger. Why? Because emotions take over. During a recession, fear is everywhere. The news is terrible. Stock prices are falling. Your friends are panicking. Your spouse is worried. And in that moment, trying to make rational investment decisions is almost impossible. Your brain is screaming danger. Run, protect yourself. And if you're trying to research companies, analyze financial statements, figure out what to buy, you're probably going to make mistakes. You're probably going to either buy garbage because it's cheap, or you're going to freeze and do nothing. So you prepare ahead of time. Right now. Today. When things are calm. When you can think clearly. You make a shopping list. A list of businesses you'd love to own if only they were cheaper. And here's the key. You focus on quality. Great businesses. Companies with strong competitive advantages. Companies with pricing power. Companies with loyal customers. Companies that will survive the recession and come out stronger. I'm not interested in buying junk just because it's cheap. A bad business is a bad business at any price. But a great business at a discount, that's what I'm looking for. So, how do you identify these businesses? Let me walk you through my framework. First, I look for companies with durable competitive advantages. What I call economic moats, something that protects them from competition. Maybe it's a strong brand. Coca-Cola, Disney, Apple. People pay more for the brand. Maybe it's network effects. Facebook, Visa, American Express. The more people use it, the more valuable it becomes. Maybe it's switching costs. Your bank, your insurance company. It's a hassle to switch, so people don't. Maybe it's cost advantages. Walmart, Costco. They can undercut everyone on price. Whatever the source, the company has something that protects it. Something that means it can earn high returns on capital year after year. And that protection, that moat, it doesn't disappear during a recession. The moat is still there. The business is still strong. Just the price is temporarily depressed. Second, I look for companies that sell products people need, not just want. In good times, people buy all kinds of things. Luxury items, entertainment, fancy gadgets. But in bad times, they cut back. They focus on necessities. So I want companies selling necessities. Food, medicine, utilities, insurance, basic consumer goods. Things people can't stop buying even when money is tight. Third, I look for companies with strong balance sheets. Low debt, lots of cash, good credit ratings. Because in a recession, companies with too much debt get into trouble. They can't make their payments. They go bankrupt. Shareholders get wiped out. I've seen it 100 times. A company looks cheap, you buy it, then it goes to zero because it couldn't survive the downturn. So the balance sheet matters enormously. Fourth, I look for companies with good management. Honest, competent, shareholder-friendly management. People who've been through downturns before. People who run the business conservatively. Who don't take stupid risks. Who think long-term. Because when the recession hits, management matters more than ever. Good management will make smart decisions, cut costs carefully, protect the core business. Bad management will panic, make desperate moves, destroy value. So you go through this process. You screen thousands of companies. You narrow it down to maybe 20 or 30 that meet your criteria. Then you study them. You read their annual reports. You understand their business models. You look at their history. You figure out what they're worth. What's a fair price? What's a bargain price? What's a steal the company price? And you write it all down. You make a spreadsheet. Company name, business description, why you like it, what you think it's worth, what price you'd be happy to pay, and you keep that list handy. You update it periodically. You refine it as you learn more. Then, when the recession comes, you don't have to think. You just look at your list. You check the current prices. And when something on your list hits your target price, you buy. Simple. Mechanical. Unemotional. That's how you overcome the fear. That's how you act when others can't. Let me give you a concrete example from my own history. American Express. In 1963, there was something called the salad oil scandal. Sounds comical now, doesn't it? But at the time, it nearly destroyed American Express. Here's what happened. A subsidiary of American Express had provided warehouse receipts for salad oil. Essentially, they guaranteed that certain tanks contained millions of pounds of salad oil as collateral for loans. Except the tanks didn't actually contain oil. They contained water with a thin layer of oil on top. The whole thing was a fraud, and when it unraveled, American Express was on the hook for the losses. hundreds of millions of dollars. The stock plummeted. People thought the company might go bankrupt. But I'd been watching American Express for years. I knew their core business. I knew they had the charge card, the traveler's checks, the financial services. I knew their brand was incredibly valuable. I'd done my homework. I'd walk into restaurants and watch people pay with their American Express card. I'd go to banks and see people buying American Express traveler's checks. The scandal had nothing to do with those businesses. It was a separate subsidiary. The core business was fine. So I bought. I put 40% of my partnership's money into American Express. 40%. That's an enormous bet. Everyone thought I was crazy. The stock was falling. The news was terrible. Why would you buy more? But I had conviction because I'd done the work. I knew what I owned. I knew what it was worth. And I knew it was on sale. That investment made me many multiples over the years. Held it for decades. Made my partnership, and later Berkshire, hundreds of millions of dollars. But here's the thing. I could only do that because I'd done the homework before the crisis. I knew American Express inside and out. So when the opportunity came, I was ready. I wasn't scrambling to figure out if it was a good company. I already knew. I just had to execute. That's what I mean about making your shopping list now. Do the work today so you can act tomorrow. Part 3. Master your psychology. Third part of the strategy, and honestly this might be more important than anything else, you have to master your psychology. You have to train your mind. You have to build the mental discipline to act rationally when everyone around you is panicking. This is hard. This is really hard. Because humans are wired for certain behaviors that made sense in the evolutionary environment, but are terrible for investing. We're wired to follow the crowd. If everyone's running, we run too. Don't stop to think. Just run. That kept our ancestors alive when predators were chasing them. But it's death in the stock market. We're wired for loss aversion. We feel the pain of losses much more intensely than the pleasure of equivalent gains. Losing $1,000 hurts about twice as much as gaining $1,000 feels good. So when stocks are falling, we feel intense pain, intense pressure to make it stop. And the way to make it stop is to sell. Get out. Stop the bleeding. But that's exactly the wrong move. We're wired for recency bias. Whatever happened recently, we assume will continue. Stocks have been going up. They'll keep going up forever. Stocks have been going down. They'll keep going down forever. We extrapolate recent trends into the future, ignoring the cyclical nature of everything. So how do you overcome these hardwired instincts? Practice. Mental rehearsal. Visualization. You train yourself like an athlete trains for competition. You imagine the scenario over and over so that when it happens for real, you're prepared. Here's what I want you to do. Sit down in a quiet place. Close your eyes. Imagine the next recession. Imagine turning on the news and seeing red numbers everywhere. Imagine your portfolio down 20%, 30%, 40%. Imagine your neighbor telling you he lost his job. Imagine your brother calling, panicked, asking if he should sell everything. Imagine the fear. Really feel it. Let it wash over you. Now imagine yourself staying calm. Imagine yourself pulling up your shopping list. Imagine yourself checking the prices. Imagine yourself seeing a company you've wanted to own for years, now trading at 50% off. Imagine yourself placing the order. Buying more. Buying into the fear. Imagine the feeling of conviction. Of knowing you're doing the right thing even though it feels scary. Do this exercise regularly, once a month, once a week if you want. The more you rehearse it mentally, the easier it will be to execute when it's real. Athletes do this all the time. They visualize success, they imagine the game-winning shot, the perfect swing, the clean routine, and when the moment comes, their body knows what to do, because their mind has been there 1,000 times already. That's mental preparation. That's how you build courage. And courage, real courage in investing, is not the absence of fear. It's acting correctly despite the fear. It's feeling the fear and doing it anyway. I remember 1974. That was a brutal recession. The worst since the Depression at that time. Stocks had fallen 50%. Inflation was raging. The oil embargo was choking the economy. Watergate was destroying trust in government. Everything felt broken, and I was buying. But I'd be lying if I said I wasn't scared. I was. Every day I'd read the paper and wonder if this time was different. If this time the recovery wouldn't come. But I kept buying because I'd trained myself. I'd been through downturns before. I knew what to do. And that's the only way to do it. You can't logic your way out of fear. You can't read a book and suddenly be immune to panic. You have to train. You have to practice. You have to build the mental muscles over time. Part 4. Never use leverage. Fourth part of the strategy, and I cannot stress this enough, never, ever, under any circumstances, use borrowed money to invest. Never. Leverage is the enemy. Leverage is what destroys investors during recessions. Here's how it works. And I want you to understand this because I've seen it ruin so many people. People who were smart, disciplined, successful in every other aspect of their lives, but they made this one mistake and it wiped them out. You borrow money to buy stocks. Maybe you open a margin account with your broker. They'll lend you money against your portfolio. Or maybe you take out a home equity loan. Or a personal loan. The stocks are going up, so it feels safe. It feels smart. You're using other people's money to amplify your returns. If you put in $100,000 and borrow another $100,000, you've got $200,000 invested. And if stocks go up 20%, you don't make $20,000, you make $40,000. Your return doubled. Amazing, right? But then the recession hits. Stocks don't go up 20%, they go down 30%. Now your $200,000 investment is worth $140,000. You've lost $60,000. But you still owe the lender $100,000, so your equity is only $40,000. You started with $100,000 of your own money. Now you've got $40,000. You lost 60% while the market only fell 30%. The leverage amplified your losses, and it gets worse. If stocks fall enough, you get a margin call. The lender wants their money back. They're worried you won't be able to repay, so they force you to sell. Right at the bottom. Right when prices are lowest, you get wiped out. Game over. I have never used leverage in my personal investments. Never. Not once in 75 years. And Berkshire uses very, very little leverage. We have some insurance float, which is a form of leverage, but it's very low cost and very stable. We don't borrow to invest. We don't use margin, ever. And it's not because I'm conservative or risk-averse. I've made some very concentrated bets in my career. I've put huge amounts of money into single stocks, but I've never done it with borrowed money. Because here's the thing about investing. The whole point is to compound wealth over time. You start with a little. You earn returns. You reinvest those returns. You earn more returns. Over decades, it compounds into a fortune. That's how it's supposed to work. But leverage can wipe you out in a single event. One bad year, one margin call, and you're back to zero. Or worse, negative. And if you're wiped out, you can't compound anymore. The game is over before you really got started. Let me tell you about long-term capital management. This was 1998. A hedge fund run by some of the smartest people on Wall Street. I mean, genuinely brilliant people. John Meriwether, the legendary bond trader. Robert Merton and Myron Scholes, Nobel Prize winners in economics. These guys had forgotten more about finance than most people will ever know, and they built sophisticated mathematical models. They identified arbitrage opportunities in the bond market, tiny price discrepancies that they could exploit, and the models worked. For a while, they were making amazing returns. But they were using massive leverage. They had borrowed $100 for every $1 of their own capital. Some positions were leveraged 50 to 1, even 100 to 1. Then the Russian government defaulted on its debt. A completely unexpected event. The models didn't predict it. Markets panicked. Prices moved in ways that the models said were impossible. And with all that leverage, long-term capital management started losing billions. They couldn't meet their margin calls. They were going to collapse. And because they were so big, so interconnected with every major bank on Wall Street, their collapse threatened to bring down the entire financial system. The Federal Reserve had to step in. They organized a bailout. 14 banks pooled together $3.6 billion to save long-term capital management and prevent a systemic crisis. The investors lost everything. The brilliant Nobel Prize winners with their sophisticated models didn't matter. The leverage killed them. So learn from that. Learn from the hundreds of other examples throughout history. Leverage feels like it's helping when things are going well. But when things go bad, it's like pouring gasoline on a fire. It turns a manageable problem into a catastrophe. Only invest money you truly don't need. Money you won't need for at least 5 years. Preferably 10 or more. That way, when the recession comes, you can hold on. You don't have to sell. You can wait for the recovery. And the recovery always comes. It might take a year. It might take 3 years. But it comes. Unless you're leveraged. If you're leveraged, you might not survive long enough to see the recovery. Part 5. Diversify intelligently. Fifth thing. Diversification matters, but not the way most people think about it. See, the conventional wisdom says you should own hundreds of stocks. A little bit of everything. That way you're protected. If one goes down, the others balance it out. And there's some truth to that. But it's also nonsense. You can't possibly understand hundreds of businesses. You just can't. I don't care how smart you are. I don't care how much time you spend. There aren't hundreds of businesses worth understanding. There just aren't. So what happens is people buy these broad index funds, or they own 200 stocks, and they have no idea what they own. They're just hoping that collectively it goes up. That's not diversification. That's just confusion. Real diversification, intelligent diversification, means owning a concentrated portfolio of great businesses in different industries. Maybe 10 stocks. Maybe 15 if you're really actively managing it. Maybe 20 at the absolute most. But each one should be a business you deeply understand. A business you've studied. A business you'd be happy to own for 10 years. A business with strong fundamentals, good management, durable competitive advantages. And they should be in different sectors. Different industries with different economic characteristics. That's how you protect yourself. Because recessions don't affect all businesses equally. Some get hammered, some do okay. Some actually do well. For example, you might own a bank. Banks get hit hard in recessions because loan defaults increase. So that's risky. But you might also own a utility. Utilities do fine in recessions because people still need electricity, still need water, still need natural gas. Those bills get paid. Or you own a consumer staples company. People still buy toothpaste and soap and toilet paper and food. Those businesses are stable. So your portfolio might look something like this. 1 or 2 banks, because they're trading at low valuations and they'll recover. 1 or 2 consumer staples companies for stability. 1 or 2 utilities or infrastructure companies for steady cash flow. 1 or 2 insurance companies because I understand insurance. 1 or 2 industrial companies. 1 or 2 healthcare companies because healthcare demand is pretty consistent. 1 or 2 technology companies if you understand tech. That's maybe 10 to 15 stocks. Different businesses, different economics, different risks. That's diversification. And the beauty of this approach is you actually know what you own. You can explain each business. You can track each business. You can make intelligent decisions about each business. During 2008, while the banks were getting destroyed, while the cyclicals were collapsing, my consumer staples holdings kept performing. Procter & Gamble kept selling diapers and laundry detergent. Johnson & Johnson kept selling Band-Aids and Tylenol. Coca-Cola kept selling 1 billion drinks a day. These businesses just kept doing what they do. They kept paying dividends. They kept generating cash. And that stability gave me confidence. It gave me the mental fortitude to buy more of the beaten-down cyclicals. Because I wasn't worried about my entire portfolio going to zero. I had a foundation. I had businesses I knew would survive. That's smart diversification. The other thing about diversification is this. During a recession, you want to overweight the defensive sectors going into it. The utilities, the consumer staples, the healthcare companies. Boring businesses that just keep churning along. Then once the recession hits and the cyclical stocks get really cheap, you can rotate some money into those, buy the banks when they're down 60%, buy the industrial companies when they're down 70%, but you maintain that stable core. I remember Warren Buffett saying diversification is protection against ignorance. And there's truth to that. If you really knew what you were doing, if you really understood a business deeply, you could put all your money in that one business and do fine. But most of us aren't that good. Most of us need some protection. We need to admit we might be wrong about something. So we diversify across a handful of truly great businesses. That's the sweet spot. Concentrated enough that your winners really matter. Diversified enough that your losers don't kill you. Part 6. Study the balance sheet. Sixth part of the strategy. Watch the balance sheets. In a recession, companies with a lot of debt get into serious trouble. They can't make their payments. They go bankrupt. Shareholders get wiped out. Meanwhile, companies with strong balance sheets, they survive. They even thrive. They take market share from the weak companies. They come out stronger. So when you're building your shopping list, one of the very first things you check is the balance sheet. How much debt does the company have? What are their interest payments? What are their cash flows? Can they service their debt even if revenue falls 30% or 40%? If the answer is no, cross them off your list. Find a different company. I can't tell you how many times I've watched investors buy a stock because it looked cheap. The price had fallen 80%, so it must be a bargain, right? But they didn't check the balance sheet. They didn't see that the company had $10 billion in debt and was losing money. And then the company goes bankrupt and the stock goes to zero. And the investor is confused. But it was so cheap. How did I lose everything? Price and value are different things. A stock can be cheap in price and still be worthless if the company can't survive. That's why the balance sheet matters so much. Strong balance sheet, low debt, lots of cash, good credit rating. Those are the companies that survive. Those are the ones you want to own. Let me give you a specific example. During the 2008 crisis, every major bank was struggling. They were all down 70%, 80%, 90%. The entire sector looked like a catastrophe. And some banks were a catastrophe. They had made terrible loans, had complex derivatives positions they didn't understand, had borrowed too much money with too little capital. But some banks had been run more conservatively. JP Morgan Chase, for instance. Jamie Dimon had run that bank carefully. He hadn't loaded up on subprime mortgages. He'd maintained strong capital ratios. They had liquidity. They had a fortress balance sheet.